welcome to our webinar today. Myself and my partner Corey Daharsh are going to talk about backdoor Roth IRAs and mega Roth 401ks. We're also going to talk about two other types of accounts very briefly, but since Secure Act 2.0 made some changes, we'll talk very briefly about other types of accounts that allow Roth contributions. My name is Larissa Greene. I've been with Advanta IRA for almost 13 years now. My contact information is here. I started doing administrative work for Advanta and eventually moved over to business development and education, where I have been doing webinars, teaching classes, and networking for Advanta for probably about 11 years now. How are you doing today, Corey?
Hey, Larissa, I'm doing very well, thank you. For the audience, my name again is Corey Daharsh. I've been with Advanta for about 8.5 years. Spent about half my time with the company thus far on the account management side, handling day-to-day transactions and assisting clients with rules and regulations and strategy for their accounts. And then about 4 years ago, roughly, I switched over to business development, where I now do what Larissa just outlined: educational content, networking, teaching people how to use these accounts and helping them get their accounts set up. So if you have any questions for either of us, please feel free to use the questions box as we're presenting. As long as it relates to the presentation, we'll go ahead and answer them in the moment. Otherwise, we have a question slide at the end when the presentation is concluded to go over any miscellaneous items that may otherwise take us off track with the nature of today's presentation. And yeah, that's about it for housekeeping. Oh, one more thing. If you'd like a copy of today's presentation, it's already uploaded in the handouts section of GoToWebinar. So you can go ahead and download that there. Otherwise, you'll receive a recording emailed to you in about 24 hours, and this will also go up on our YouTube page. Larissa, I'll turn it back over to you.
Great, thanks, Corey. Yeah, go ahead and type your questions into the chat box as we go. We do keep everybody muted just for the sake of the recording. A little bit about Advanta. We have over 20 years experience in our field, and we have around or a little over $3 billion in assets under administration. There are 2 Advanta offices. We are here in the Clearwater area of Florida, and then we are also in Atlanta, Georgia, but we can actually help anyone anywhere. And I can probably speak for Corey as well when I say we have clients nationwide and even worldwide. So we can, as long as you have a US-based retirement account, we can help you self-direct that retirement account into alternative investments. And we're really not going to focus on the investments that Advanta IRA and self-directed IRAs in general allow you access to today. We're going to focus more about the Roth strategy. And so very specifically, we're going to go into details about how to make contributions Roth, and there's a few different ways to do that. So I do just want to tell you, because we're going to be talking today about taxable events, to keep in mind that we don't give tax, legal, or investment advice at Advanta. We're going to share some strategies with you, but ultimately you want to make sure to check in with your attorney, your accountant, or your financial advisor before entering into any type of investment or doing any type of Roth conversion or taxable event within your account. And that's super important, because you're going to see there are going to be some taxable events that we're going to be talking about in order to make Roth contributions and Roth conversions. Some key points for you. There are many ways to contribute to a retirement plan for tax-free growth. And like I said, Secure Act 2.0 made some changes, and so you're going to see where there's more opportunities to make those tax-free contributions. And remember, you're making contributions after tax, and then they're going to grow tax-free, and we'll talk about that. Contributions to a Roth IRA have an income limit, but it is still possible to contribute. So that's the backdoor Roth IRA, as it is termed, and we'll talk about that. And it's important to understand when contributions are allowed and the steps to take in order to make those. So we have up here for you retirement plan contributions, and you're going to see how these different types of plans have different contribution limits for every year, and some of them are dependent upon the amount of earned income that you have. So for example, a traditional or Roth IRA, the contribution limit is $7,000 or $8,000 if you're over the age of 50, but when you're looking at a Roth IRA, there is also an income limit that applies. So if you make too much money, essentially, then you're not going to be able to contribute directly to the Roth IRA. And we're going to talk about those conversion strategies to get that money into the Roth. But now as we go down the list, a SEP IRA, simple IRAs, and solo 401ks allow contributions that are Roth, and so ultimately will grow tax-free. And so there's a huge advantage to these accounts, and Secure Act 2.0 brought some more of that forward, allowing you to make those contributions and have that tax-free growth. Something else I do want to point out before I go on is that the way you make contributions to some of these plans has changed. So with the SEP IRA, for example, again, you can make Roth contributions. That's an employer contribution. With a simple, you're going to be able to make employer contributions and employee contributions that are Roth. And they've also changed the limits. So you can now make larger contributions as the employee if you're between ages 60 and 63, and that has also changed for the 401k. So ages 60 to 63, you get a larger contribution during those years that change the amount you can contribute again as Roth. So that's really sort of helping you make those larger contributions as Roth if you choose to do so. With the Secure Act changes, you are going to see that now, again, SEP and simple plans have the potential to offer the Roth contributions. If it is your plan, you'll want to check with the administrator. So just check to make sure how you can make those contributions as Roth. Some administrators might still be working on ways to do record keeping for those contributions, or you may be able to simply reach out and say, hey, I have a SEP or I have a simple, I want to update that plan in order to make the Roth contributions. What do I have to do? And that is going to be the same with the 401k plans and employer contributions that are going to be considered Roth. It is my understanding with employer contributions that there's going to be a checklist so that you can basically opt in for those Roth contributions. So you want to check to see if your plan allows it, and then also make sure you get the form that you'll need in order to opt into employer Roth contributions for the 401k. And also with the Secure Act, you no longer have to take required minimum distributions on the Roth portion of your 401k. So that's going to change the plan a little bit as well.
And Larissa, as we go ahead, I'm sorry.
Yeah, I was just turning it over to you, Corey. Take it away.
Oh, there was a question that came in 2 slides ago when you were covering the 2025 limits. Someone had asked which of these options are available for people over 75 years of age that have an existing IRA but do not have an existing Roth. So if you're over 72 and a half, which I believe right now is the required minimum distribution age, you're not really at that point eligible to contribute further into a traditional account. So you could convert that to Roth and or make Roth conversion contributions potentially. And then the other plan types, as long as there's not a required minimum distribution required, you could still hold the account type and contribute into it. But once you're at RMD age, you're no longer allowed to add more money to the account. The IRS is actually starting to mandate that you start pulling money out of the account. Larissa, did you want to expand on that at all, or do you think I covered it?
Yeah, but just a little clarification. So with Secure Act and Secure Act 2.0, there were a few changes there. So if you already started taking required minimum distributions, you do have to continue. If you have not reached age 73 yet, then 73 will be your required minimum distribution age. And even if you have to take required minimum distributions, the caveat there is you do have to have earned income, but as long as you have earned income, you can contribute to any type of retirement account. So at 75 years of age, as long as you have earned income, you can make those contributions. You may still have to take a portion out every year based on the required minimum distribution amount, but you can still make contributions. You can have a Roth IRA, again, as long as you have earned income. And you may be subject to holding periods, which are called 5-year aging rules, if you have never established a Roth IRA and have none established currently. So there is some things to be aware there, but you may still be able to make contributions, again, dependent on having earned income.
Perfect. Thank you very much. And that is why we do these webinars in tandem, because sometimes one or the other of our memories misstep us a little bit. So thank you for the clarification, Larissa. 73, not 72 and a half, as I misspoke there on the required minimum distribution age at this time. All right, moving forward with the slide here on backdoor Roth. So what is a backdoor Roth? Basically, what it means is your income limitation is higher than the limitation allowed to make a Roth contribution. So the backdoor component is the fact that the IRS allows you to make a contribution into a traditional IRA, no matter what your income is, and then you just Roth convert it once you put it into the traditional IRA. Depending really on your modified adjusted gross income is where you stand with your ability to make a Roth contribution. There's a threshold, which I'll cover here in a moment. If you're making a certain limit, but not over a certain limit, you can make a progressive contribution into the account that's prorated. And then once you reach a certain income limit, then you're just not allowed to contribute into a Roth account whatsoever. But again, that's what the backdoor component is here for. You're allowed to contribute into a traditional account. You get a tax write-off when you do that, or a voucher essentially, and then you just turn around and hand that right back to the IRS, pay the taxes on that money, and let your account grow completely tax-free in a Roth moving forward. With the backdoor Roth, you can contribute into the traditional with no income limitations on what you're doing there, and then convert either just that contribution limit or potentially the entire traditional IRA over to Roth at your convenience. And just to set the precedent here as well, these annual contribution limits typically change annually. There was a bit of a moratorium, if you will, on the income limits, or I'm sorry, the contribution limits going up during COVID, but we're back to seeing roughly $500 to $1,000 raise in your annual contribution limit per year. We always reach out and notify our client base in our network once that's released by the IRS what the income contribution limit's going to be for the next calendar year tax filing year. So keep an eye out for that if that's something you're interested in. And we'll go ahead on to the next slide here. Oh, bumped up twice. So I just mentioned a moment ago what those income limits are for Roth contributions or conversions. So if you're married filing jointly and your income is less than $236,000, then you can contribute a full $7,000 or $8,000 into a Roth IRA, perfectly fine and simple put. If your income limit's between 236 and 246, so that $10,000 window there's a proration to how much you're allowed to contribute directly into that Roth. And then if you're making over 246,000 married filing jointly, you cannot contribute into a Roth, so you're in a position where you have to contribute into a traditional and then convert to a Roth. If you're married filing separately, once you're making $10,000 or more, you're not able to contribute into a Roth directly. You'd have to do a traditional and then convert to Roth. And the caveat here is if you lived with your spouse anytime during the year. So married filing separately, maybe you're going through a separation or something like that, those things occur, and that does have an impact on that $10,000 income limit for the Roth contribution. And then if you're single or filing head of household or married filing separately, if your income is less than $150,000, you can contribute directly into a Roth. Between $150,000 and $165,000, so an actual $15,000 window, you can contribute to a Roth on a prorated basis. And then over $165,000, you're unable to contribute to a Roth. But again, the nature of today's webinar, don't worry, contribute into a traditional Roth, convert that, and then you'll be good to go. All of the information we're displaying here is also on the IRS's website. The link is right there on the bottom of the page for citing purposes.
We had a few questions pop up. So the first one of, there are a few other questions asking how much you can contribute to the 401k. So we're going to talk about that. So hold on just a second. We're going to explain how those contributions work. But the traditional IRA contribution will not be taxable. Is that correct? That depends. That's a whole nother table. If you or your spouse contribute to an employer plan dependent on your income, then you may or may not be making deductible contributions to your traditional IRA. So if you earn a certain amount and you're contributing to an employer plan, then you have to talk to your accountant or check out the table. That's also on the IRS website. We did not include that here as to whether or not your traditional IRA contribution will be deductible. So I hope that's helpful. And again, it is on the IRS website, so you should be able to find that there. Somebody also asks about non-deductible contributions and then doing the conversion. So I think we might talk about that, but I'll address it really quick here. If you're making a non-deductible traditional IRA contribution and you convert it to the Roth, how does that work? The answer is it depends. If you have traditional IRAs in existence, then you're going to be doing a conversion, even if it's non-deductible, on a prorated amount as far as tax is concerned. There's actually a formula for that that you can look up to see how much will be taxable. This is really not a question, Corey, and I can answer for you, but it is definitely a great question for your accountant so that they can help you understand those non-deductible contributions and how the taxation will work for that contribution once you do the Roth conversion portion. Let me see if there was anything else we can address right away.
Okay.
There was a question about what income limits are included. Please click on the link or take the link and follow that to the IRS explanation of what income is included in the modified adjusted gross income. That's not a question for us to address with you, but it is a great question again for your accountant. And I'll turn it back over to you, Corey.
All right, thank you very much, Larissa, for addressing those. Again, please use the questions box for any questions that come up. Sometimes we see the hand raise feature, but the audience will be muted for the duration of the presentation. So making a backdoor Roth contribution is a very simple process. You make a contribution into your traditional IRA, which you could either already have set up with us, or maybe you have it set up with a fiduciary custodian like a Fidelity, Edward Jones, T. Rowe Price, one of those companies. Nonetheless, have a traditional IRA or set one up, make a contribution into it, and then conduct a Roth conversion. So it's usually just a simple one-page document. Maybe you could do it with your custodian online, but decide and document to them how much you're looking to convert to Roth, whether it's the specific contribution amount, or maybe that plus some other funds you had setting aside already in that traditional IRA. And then thirdly, check with their CPA on any tax implications. Again, just reminding you guys that Larissa and I are not here to provide tax advice, legal advice, or financial advice. But what I will say, and I typically say when I'm speaking with new investors, is it may be a good idea. I'm not saying it is a good idea, but it may be a good idea to consider how much your adjusted gross income is for any given tax filing year, and basically decide or figure out what tax bracket that puts you into, and then consider contributing right up to the amount or converting right up to the amount to Roth, what would bump you up into the next tax bracket. So you're taking the most advantage of getting in that tax bracket at the percentage you're at. Maybe it's the 22% tax bracket, maybe it's the 24% tax bracket. Converting that in that tax filing year so that that money can grow tax-free moving forward, and you're not, again, putting yourself in a detriment as far as your tax implications go. Again, the contribution amounts are added to your retirement account, and they are subject to the limits that we've been discussing. Any separate earnings from the investments that you make are unlimited. So what you actually earn once the money is within the retirement account is passive income, and that is not the same or tied to your annual contribution limit.
We also had a question pop up about which income we're talking about, AGI or gross. It is a modified adjusted gross income per the tables. If you check out that page on the IRS website, you're going to see modified adjusted gross income. And then the other question was, how are the taxes paid? So when you do a conversion, you're going to receive a 1099 for that tax year. So let's say that you do a $50,000 Roth conversion, for example, because it doesn't just have to be your contribution, it can also be amounts in a pre-tax account. Then when you do the Roth conversion, you're going to receive a 1099 for $50,000 for that tax year. So if I do that this year, then I'm going to receive a 1099 for my 2025 taxes to show that additional $50,000 as ordinary income. It is not something that you take out of the retirement account. It is a 1099 to you. So you want to keep that in mind. And as Corey mentioned, again, reaching out to your accountant about this. Typically, we will see people do Roth conversions for a few different reasons. Maybe they had a lot of losses that year to offset the taxable liability, or maybe they had less in income. We also see people do that when they're, kind of predicting a windfall as far as the return in the investment they want to make with that money. So again, checking with your accountant and keeping in mind too that you can do Roth conversions, not just backdoor Roth conversions for your contributions, but you can do Roth conversions in any amount from pre-tax accounts, and you can do them over time. So your strategy is your own.
Thank you very much, Larissa. Actually, Larissa's answer there covered the second bullet point on this slide, so I'll go ahead and just reiterate that one quickly. When you do a Roth conversion, you will be issued a 1099-R by your IRA custodian, which will basically include that amount on your personal income tax. So that is added to your ordinary earned income that you're filing taxes on in that year, which alludes to the first bullet point here. If you or your spouse have a 401k through your employer, contributions to the traditional IRA may not be tax deductible based on your modified adjusted gross income. Larissa mentioned this a few slides ago, answering a question from one of our audience members today. You'll want to check with your CPA or tax preparer on how this impacts you in your specific scenario. And then if you have any traditional IRAs anywhere, your Roth conversion is prorated, so you should speak with your CPA on how this works. So basically, very simply put, $8,000 if you're over age 50, $7,000 if you're under age 50. That's your total amount. So you need to work out throughout the year how you're splitting that annual contribution. So it could be 7 in one account, 1 in the other, but basically $8,000 in total, not $8,000 into my traditional and $8,000 into my Roth. So it's all something that your tax preparer really should be helping you with. We're here to kind of give you the pieces to put the puzzle in front of that person, and that person's there to put the puzzle pieces together in your specific scenario and help you with their expertise, put yourself in the best situation for these types of accounts. Sorry, having trouble just getting the slide to advance. There we go. So a solo 401k, that is a plan type that works for individuals that are self-employed or small business owners. And there are some great benefits to that plan type if it fits your needs and you are a good candidate for it. There's a higher funding limit because you can defer larger amounts of money. So with a solo 401k, you have to think about it. This is a employer-sponsored plan. The employer is your small business or sole proprietorship. And for that plan type, you can make employee contributions, employer contributions, and employee after-tax non-Roth contributions. Or basically, for the most part, the employer, the business, can put money into this plan, and then you, the employee, can defer salary into this plan as well. There are rollover opportunities, so you can consolidate other tax-deferred plans into a solo K. You can access tax-free loans, which are also considered or called qualified participant loans to yourself. So you can use a solo K to actually loan yourself money for outside of retirement investment purposes. And this plan type is also not subject to UBIT or UDFI tax on leveraged real estate investment. So if you're looking to purchase a piece of real estate in your retirement account and utilize financing, maybe you've got 300K and you want to buy a 400K property. If you do that through an IRA, that 100K that you're financing is subject to UDFI tax, which is taxed at the trust income tax rate, which I believe is 39%. 401k plans are not subject to that tax. So it's a great strategy for investors that are trying to do those types of investments, if they qualify for it, to do so through a solo 401k. The administration on these plan types is very cost effective. We've got 3 different plan options. Our most cost effective one at this point is $300 a year. It's called the Do Your Own Plan model. You can reach out to Larissa or I if you want to learn more about that. You can have Roth funds in a 401k. So our plan allows you to have traditional and Roth funds. There's different ways that we manage and facilitate the record keeping for that based on the plan type you choose. Not all plans have these components, so this is something that we offer that not everyone out there does offer. And if you have an older version of our plan, maybe you set up a solo K with us 6, 7, 8 years ago, reach out to your client account manager or reach out to Larissa or I. We can talk to you about the newer options that we have and see what might fit your needs best at this point in time so that you can maybe change your plan type. It's always good to do some of that spring cleaning. We're in springtime this year. Why not do so with your retirement account to make sure you're in the best product for your needs?
Corey, we had a few questions pop up. After making my traditional IRA contribution, how quickly am I eligible to do the Roth conversion? And the answer to that is you can do it at any time. Oftentimes, when we set up an account for an individual who plans on using the backdoor strategy, we'll set up both. The traditional IRA will be set up at the same time as the Roth. We also have the individual complete the Roth conversion form at that time. So once we receive the funds for the annual contribution, we can go ahead and do the Roth conversion at that time. So there isn't really a waiting period necessarily. We just go ahead and get it done if that is your intent. You can convert assets, so you can convert assets that you hold within your IRA account to a Roth. So if you decide, hey, I already have a traditional IRA, we've had it for years, it has assets in it already, can I do a conversion? You can, but typically we'll see people doing the Roth conversion because there's less paperwork, honestly. There's a little more paperwork, a little more research involved to value those assets in order to then do the Roth conversion. So you can do it, just be prepared. There's going to be some additional information required in order to do that. Another question we have is, I have an employer plan that I rolled over to an IRA. Can I also now move it to a Roth IRA? And the answer is yes. You can now do the Roth conversion. So again, any pre-tax retirement account can typically be converted to the Roth, and that includes some employer plans. And I say some because it's, again, as Corey mentioned, dependent upon your plan and the plan allowing you to do those conversions. A question about the solo 401k and making investment into properties. This is really a great way to encourage you to check out our YouTube channel, because we do an entire series of webinars on investing into real estate. But the 401k is similar to an IRA in that it can hold alternative investments, including real estate, as Corey mentioned. So you can buy 123 Main Street, for example, you can hold it and make those investments, receive rental income, or maybe flip it if you choose. And all of that can be done either in a 401k or an IRA, with Advanta IRA as your administrator. And Corey mentioned, you know, the tax benefit of a 401k over an IRA if you're purchasing using financing. So we do have webinars on those. If you have more questions on that, you can reach out to Corey or I, and we can send you those webinars.
All right, Larissa, did that wrap up the questions at this time?
It did, Corey, thank you.
Okay, perfect. Thank you very much for addressing those. Back on track with the benefits of Roth solo 401ks. Again, solo 401k, employer-sponsored plan for your small business. So you're both the business owner and you're also the employee. So the employer and the employee, which allows you to make those contributions in the 3 different capacities I referenced earlier. Employee contributions can max out at $23,500 for 2025, and that can be completely Roth if you'd like to do so. Employee contributions can be Roth, traditional, or any combination actually. So depending on, again, where that puts you in a tax status for your tax bracket and your income that you're reporting to the IRS in that year, you may want to split it up. You may want to do full Roth if you have some of those write-off opportunities like Larissa referenced earlier in one of her answers to the audience. That's all something that your CPA should be working out with you and your tax preparation strategy. The annual limit for employee contributions is much higher than a Roth IRA. Again, $23,500 versus $7,000 or $8,000 if you're over age 50. Again, if this plan type fits your needs, for the most part, it's a no-brainer to go with this. And then the employer contributions used strictly as pre-tax or traditional, but if your plan allows, can be converted to Roth. So you can convert to that based on Secure Act 2.0, allowing you to make employer contributions Roth once you actually make them. And then please check, we can't reiterate this enough, please check with your plan provider to make sure you're allowed to make Roth component contributions into your solo 401k. And please check with your CPA or tax preparer so that you're not, in essence, shooting yourself in the foot or also missing out on opportunities to advance your money over to the Roth side of the table where you invest it and the income grows completely tax-free. And Larissa, I believe I will turn it back over to you for the next slide.
Okay, great, Corey, thank you. And we do have a couple of more questions that popped up. This is great. Keep the questions coming, everyone. So if you have you make a contribution to a regular IRA and then convert it into an existing Roth IRA, does a 5-year term for withdrawal restart from the conversion date? That is a great question. So we mentioned that there is a 5-year aging on the Roth IRA. So when you set up a Roth IRA, 2 things have to be true in order for it to be completely tax-free when you distribute money. You have to reach age 59 and a half, and it has to have been in existence 5 years from the date of the first contribution. So that's the 5-year aging period. However, every Roth conversion that you do does have its own 5-year aging. So please be aware that Roth conversions have their own 5-year aging. Another question, if I have an existing Roth IRA, can I convert a pre-tax 401k to an additional Roth IRA? If so, can I do the conversion with Advanta? So if you have I think the question that you're asking is if you have an existing Roth IRA, does the 5-year aging move over to any Roth IRA that you establish? The answer is typically yes, but again, the Roth conversion amount has its own 5-year aging period, so be aware of that. But yes, you certainly can set up a Roth IRA with Advanta and do the Roth conversion.
One thing I want to add there, and it's the converse of that question actually, but I think it's a good thing to point out to the audience because this topic gets brought up in a lot of my conversations. Money that you have in a Roth IRA cannot flow into a 401k, even if you wanted to put it in as a Roth component 401k. Just the IRS's conversion chart for plan types at this point does not allow you to move Roth IRA money into a 401k, even if your intention is to put it in as Roth money to that 401k. So I know that question wasn't specifically asked there, but it brought up in my head that thought, and I have that question asked a lot in my one-to-one conversations. I figured I'd address it here.
Yeah, that's a very great point, Corey. So now we did have a bunch of questions about contribution limits and making contributions to a 401k. And a 401k is a great account for the self-employed. You don't have to just be self-employed. So if you have a side hustle, if you're a sole proprietor, as long as you have self-employment earned income, you can make contributions to a solo 401k. If you are employed, let's say you have a 9-to-5 like Corey and I do, then you can still have a solo 401k, but your contribution limits might be subject to a formula based on what you might be contributing with your employer's plan for the 9-to-5. So just keep that in mind. You can still have it, but you do want to check with your accountant on how much you'll be able to contribute based on contributions you're already making to a 401k. So this year, again, the annual contribution limit for those under the age of 50 is $70,000. For over the age of 50, and this is 50 to 59 and 64 plus, $77,500. And then for those age 60 to 63, you get the extra boost in your contribution, which will make it $81,250. How does this work? You get employer contributions, you get employee contributions, and then you also get something called an employee after-tax non-Roth contribution. And that's a mouthful to say that you're making an additional contribution to max out the plan. This third type of contribution is not offered in all plans. So it is very important that you check on that if you do not have an Advanta plan. And again, as Corey mentioned, plan options have changed with us. So if you have an older plan, then just check in with us and make sure we can always help you update it at no cost. The employee contributions, Roth or traditional, again, Roth contributions as employee are not offered for everyone in every plan. So if you're not talking about an Advanta IRA 401k plan, check with your plan provider. And then the employer contributions can be Roth contributions, and again, that's with Secure Act 2.0, and you'll want to check with your provider. Even if you're with Advanta, there is a checklist for you to complete opting in for Roth contributions for employers. So let's do a quick example of the contributions, and then I think the next slide will go into that a little further. But your employer contribution is 20 to 25% of your earned income. So that's 20 to 25%. That variation depends on how you file for your business and how you pay yourself. So for example, sole proprietor is going to be different than a C Corp or an S Corp. So be aware of that. And that's 20 to 25% of your earned income. So if you pay yourself $100,000, Then if you're a sole proprietor, it's going to be probably closer to the 20%, which means as your own employer, you could put 20,000 in. Employee contributions are 23,500, 31,000 if you're over the age of 50, or 34,750 if you're age 60 to 63. And then 64 plus is going to be, again, that 31,000. And then the combination of these two minus the total contribution you can make is going to establish this employee after-tax non-Roth contribution amount. This third box here is what you call the mega Roth contribution. That's where that term comes from, because it's after tax, so it's not deductible, but it is not Roth. So in order to make it Roth, you have to take the extra step and convert it to the Roth bucket of your 401k so that it grows tax-free. So to make it a little more clearer, if you don't take that extra step, and it's paperwork, right? If you don't take that extra step, then even though it's after tax, it's not going to grow tax-free. So you definitely want to take that extra step.
And so Larissa, as you're moving on, there's a few questions just to address.
Yep, go ahead.
Sorry. I am 60 years old. Had you gotten to that one?
No.
I think the last one you covered was the 2 Roth IRAs merging.
Yes, go ahead.
Okay. I am 60 years old and have a 457B plan from work. Can I convert some money from 457B plan to Roth 457B? Is there any limitation for 1 year? Any income limitation? Advanta IRA can help me do this. I'm a current Advanta IRA client. So we do not offer a 457B plan. So what typically would happen with that plan type, if it's a previous employer, you can roll over funds out of that plan type into a self-directed account. In the act of conducting the rollover, you can do a Roth conversion. So pulling the money out of a pre-tax or tax-deferred account and placing it directly into a Roth account effectively does conduct a Roth conversion for you. But if you're still employed, you may not be able to move that money out. Something you'd have to ask your employer or your service provider for that 457B plan is if you're eligible for what's called an in-service rollover. Again, we don't offer 457B plans. The only employer-sponsored plans we offer are our solo 401k, our SEP, and our simple IRA accounts, which all offer the component for Roth capabilities. 457 is just a different employer-sponsored plan that we do not offer. Next question I'm seeing here. I missed the point about the difference between solo 401k versus Roth IRA for investing in real estate. I'm considering buying a property after converting from 401k to Roth IRA before I purchase the property, so my gains are tax-free. So the major thing here in kind of effect of this webinar is the Roth conversion component. The solo 401k and the Roth IRA are both allowed to obviously hold Roth funds. So the main component there, or the difference, is, as mentioned in the question, conducting the Roth conversion before making the property purchase so that the income generated by that property grows completely tax-free. I don't know if that might also be slightly alluding back to my point earlier on IRA accounts being subject to UBIT or UDFI tax when utilizing leverage in an investment opportunity for real estate, where the solo 401k is not subject to UBIT or UDFI tax. So hopefully that answered that question, and maybe even a little bit further than a specific or direct answer. Are the employee contributions subject to income requirements also? Larissa, were you about to jump on that? I'm sorry, I didn't look at the slide that you just switched it to when I cut you off there.
That's okay. I don't think we actually cover that specifically, but the question is regarding really the Roth contribution income limits, and that's for Roth IRAs. Great news, there are no income limits to making your Roth contributions to the 401k. So Roth 401k contributions are not subject to income limits. And actually, and I don't have it in front of me, so I'm not going to cite it directly, but in the future, I think it's 2026, you'll actually have to make your catch-up contributions, or the contributions you can make over the age of 50 for the employee, as Roth depending on your income. So you'll actually have to do that. So there will be Roth income limits, but meaning you have to make those contributions as Roth. So if you want more information about that, I'm happy to pull that up and email it to you. Just send me an email and I can get that information.
All right. I think there's one or two more questions before we get back into the presentation, if that's okay. Okay. Given the 5-year term restarting upon conversion, is it possible to establish additional Roth IRAs, so multiple Roth IRAs, to make the conversion instead of restarting the 5-year term on an existing Roth IRA? Larissa, I'd like your feedback on this because I actually have a few clients that at this point have opened 4 or 5 different Roth IRAs with us to kind of create a loophole in that capacity. So I believe that does work in the manner that that question was outlined, because I've seen clients utilize a similar strategy. But again, I'm not, and Larissa isn't experts on the tax law, and you know, we're not CPAs or tax preparers to give you guidance or feedback. More so, maybe reference what we've seen in the past, but ultimately that is up to the client and their CPA or tax preparer to decide if that's applicable, if that falls within the IRS's rules and regulations. Any additional feedback from your side on that?
Yeah, so I think when we see that potentially, you know, we can't be mind readers here, but potentially the idea behind that is help with record keeping. Because when you make a Roth contribution or when you do a Roth conversion, there is ordering rules for when you take distributions from a Roth IRA. I like to call them buckets. It just makes sense in my mind that when you make an annual contribution in a Roth IRA, it goes into the Roth contribution bucket. When you do a Roth conversion, it has its own bucket, and each conversion has its own bucket. And then when you have earnings, the earnings have their own bucket, and they might be related to those conversions. All of that to say that when people open additional IRAs in order to do conversions, they might just be looking at the 5-year clock for each of those and holding them out separately. But ordering rules for Roth distributions are very specific. When you first take distributions, it's automatically out of contributions you've made over time. So that's just the ordering rules for those distributions. And again, I think you can find that information very easily. But when you start taking distributions, it's automatically out of contributions. And what's really cool about Roth contributions is that you've already paid taxes on them, so you can take your contributions out without tax and penalty at any time. So up to the amount you've contributed over any number of years. Then the next bucket you would be pulling from is the Roth conversion bucket. So again, that is probably a strategy in order to continue record keeping for when that individual did the conversion and how it's aging over time. But again, like Corey said, I would definitely defer to your accountant in order to find out the best way for you to keep track of that, if that makes sense.
Got it. And a few other questions. I'll try to run through these pretty quickly. Does it cost a lot for a solo IRA plan? I think that was intended to be solo 401k plan, to have a mega backdoor Roth conversion option. If I had a solo 401k with Advanta, how much more would it cost me to have that option? There's no cost on our end. We're just executing a Roth conversion within the plan you already have based on the contributions you're making. So ultimately, I don't think there's any change in cost for executing this mega backdoor Roth strategy from our side of things. Does Advanta offer rollovers as business startup or ROBS plans? Yes, we do. We've done educational webinars on ROBS plans. You can go check our YouTube page if you want to learn more about that, or reach out to Larissa or I. Can I convert a traditional self-directed IRA to my solo 401k? Yes. You are able to consolidate funds in a traditional IRA into a solo 401k. The only funds you cannot, as I mentioned earlier, are Roth IRA funds, cannot flow into a solo 401k. Does UDFI also apply to buying a rental property inside of an HSA? Is there any way around this? HSA is subject to the same IRA rules, so yes, UBIT and UDFI tax do apply to investments you make with an HSA account. Can I do a 401k traditional and a 401k after tax non-Roth? Yes, those would be housed in the same account, but as Larissa mentioned earlier, you typically would want to just do the extra paperwork to make that after-tax non-Roth into tax for the growth capacity of that money being tax-free rather than tax-deferred. Don't want to, again, put a hat on that I'm a CPA or a tax advisor, but it just seems to make sense to just file that extra paperwork so that your money's growing tax-free as opposed to tax-deferred. Someone said they may be using multiple IRAs to avoid prohibited transactions for blowing up all IRA investments. Let's just say we don't think any of our clients intentionally are doing prohibited transactions, and always have a great resource as a client account manager or myself or Larissa to help them avoid those scenarios. Larissa, I'll turn it back over to you.
Okay, great. So now we're going to talk specific numbers. So on the last slide, if you'll recall, and we had a lot of great questions, so that's awesome. But if you'll recall, we talked about how contributions are made. There's 3 types with your Advanta 401k plan, and there may be these types as well with the plan you have if it's not with Advanta, but please check. So Jane is a sole proprietor whose 2025 salary is $100,000. So here we're going to use this specific number. We're also saying she's a sole proprietor. So again, her contribution as her own employer is probably going to be on the lower side, the 20%. And I just want to say too, and Corey probably gets this question a lot, is how can I be the employer and an employee if I'm just a sole proprietor? But for the purpose of the 401k, you do get to wear both hats, so you can make both contributions. So as your own employer, or even if you're a sole proprietor, again, in this case, Jane did have $100,000 of earned income. So different than passive income, $100,000 of earned income where she's paying the self-employment tax. She can contribute $20,000 as the employer. As the employee, she gets to put in her $23,500, so she must not be over the age of 50 in this case. And then her third contribution is going to allow her to a calculation that is going to get her to the total limit for the year. So we're going to add $20,000 to $23,500, and then we're going to subtract it from the total contribution allowed for 2025, which is $70,000. And that's how we arrive at this $26,500 number. And then total, she has now maxed out her 401k. And something I do want to point out very quickly is that you don't have to max out a solo 401k. These contributions are very flexible. As a matter of fact, all retirement account contributions, if they're defined contribution plans, are very flexible. If you have a defined benefit plan, that is different, but a defined contribution plan, so an IRA, a 401k, a SEP, a simple, these are contribution plans, defined contribution plans. Those contributions are defined by the IRS every year. You don't have to max them out. They're very flexible. So if you said, I'm going to set up a solo 401k and I can only put 10,000 in this year, I can only put 8,000 in this year, whatever it might be, you can do that with these plans. But for the benefit of getting all this money to grow tax-free, you can max out this contribution and get 70,000 as long as you had enough in earned income. Now let's look at it from a Roth perspective. The employer contribution can either be Roth, or it can be contributed pre-tax and then converted to Roth as your plan, as long as your plan allows. Your employee contribution can be Roth, or it can be pre-tax and converted to Roth, depending again on the allowance of your plan. And then the third contribution, employee, after tax non-Roth. Remember, it goes in without a deduction, but it does not grow tax-free, as we have outlined several times, unless you take that extra step and convert it to Roth. And now all 3 contributions can be Roth or converted to Roth, and therefore we have 70,000 in a 401k for Jane that is now going to grow tax-free. Your contributions are based on your business's earnings, your earned income from the business, and how you file for the business. The best to help you calculate these is your tax professional. So another slide here, just to reiterate, the after-tax non-Roth contributions have to be allowed within your plan. It's not a Roth contribution, so it grows tax deferred unless you take that extra step. The calculation is the annual limit, employer contribution plus employee contribution, subtracted from the total amount you can contribute, and then you get the non-Roth after tax. It can immediately be converted for tax-free growth. And if you plan on making an investment, remember, you can convert even after you make an investment, but it might be easier, less paperwork to convert cash. You must have the amount in earned income for the year in order to max out contributions, and you should always check with your accountant if you need help understanding your earned income versus any passive income, and also to make sure you can maximize your contribution. So I'll finish with this slide, and then we will also take some more questions. So step one, calculate your after-tax non-Roth contribution. Convert this amount, so work with your accountant or help yourself with a 1099 to file the taxable event. So again, this might just be paperwork, I can't speak to that, but if you're making a non-deductible contribution and you want it to grow tax-free, then you do have to take that extra step, file the 1099 for the conversion to show it as growing from there on tax-free, and then check with your accountant on any tax implications and making sure everything gets filed correctly. And now it's growing in the tax-free bucket, which is your Roth bucket of your 401k. Amounts added to the retirement account are subject to the limits discussed, separate from earnings, which are unlimited. So your contributions are defined again by the IRS annually, and this is separate from your earnings. And then you do have to have a triggering event to distribute funds from your 401k to a Roth IRA. So another way that people convert their after-tax non-Roth contributions is just by converting it over to their Roth IRA, which could work, but you either have to be a certain age, no longer work for the company, or some other qualifying events in order to move money from a 401k to an IRA.
So what plan type is best for you? The good thing is you don't necessarily have to choose one or the other. You can contribute into both. So your IRA contribution, as I mentioned earlier, is tied to your traditional or Roth IRAs and is concurrent. So you're annually allowed to do $7,000 or $8,000 in total into an IRA, whether it be traditional or Roth, or if you have to do one of these backdoor strategies like we've been talking about today. But completely separate and independent of that, you can have a qualified plan, a 401k, in our case, a solo 401k, that you separately are able to contribute into and maximize that amount, and ideally Roth convert that amount potentially as well. So they're not tied to each other regarding those plan types. You can have multiple. In some cases, you may not be able to contribute directly into the Roth. Again, see the modified adjusted gross income, and then check with your CPA or tax preparer. I've probably said that 100 times in today's webinar to find out if your traditional IRA will be deductible based on your income and participation in the 401k plan, possibly your spouse as well, and not the same limits as Roth contributions with those, specific factors. So again, these are all plan types you can take advantage of. Speak with Larissa or I if you want to learn more about what plan types fit your needs best, and we can help you put the pieces again in front of you, and then it'd be up to the appropriate professional to put those pieces to your individual puzzle together in the right spots for you. Real quickly, before we jump into the rest of the questions we had today, I just want to share with you that we do have a lot of educational content that you can take advantage of. We've mentioned a few different times some other webinars on different topics, Rob's plans or other different strategies. We put up 2 of these educational webinars like you're participating on today a week, every Tuesday and Thursday typically, notwithstanding holidays falling on those days. You can find all the recorded ones from the past several years on our YouTube channel, so Advanta IRA on YouTube. We also have a podcast that our colleague Alex Perney hosts. It's called the Alternative Investing Advantage Podcast. Anywhere you get your podcasts, you can find that. Take a listen to some episodes. He brings on great guest speakers, and it's less educationally strictly driven and more of a free-flowing conversation with various experts in the world of investing. So you may find some great resources there and possible people that you may want to invest in or invest with in the future. And then also we have a blog. So if you go to our website, you can check out the blog that we post. Anytime there's any potential legislation affecting retirement account investing or self-directed specifically, we put information out on that. We've had change.org petitions based on some legislation in the past that have actually helped get some restrictions taken out of legislation that would have really taken a hit to retirement account investors that are self-directing. So if you're interested in any of that stuff, please feel free to check it out at the appropriate channels and places. And we'll go ahead and wrap up the last few questions. I know we're tight on time here, but let's see how many we can get through before the end of the hour.
So the first question is, can I get a copy of this presentation? The slides themselves are added here for you, so you can go down to the handout section of your navigation and download the slides, and then the presentation recording will be emailed to you. It's typically at the end of the day or the next day, so you'll probably get it tomorrow. Can you discuss options with an inherited IRA and converting it to Roth? I'm sorry, unfortunately, inherited IRAs cannot be converted to Roth. The only exception to that is if you inherited the IRA from your spouse, because then you can treat it as your own and do the conversion. So an inherited IRA from a family member or a close friend, whatever it might be, aside from your spouse, cannot be converted to Roth. We had a question specific to the difference between and finding modified adjusted gross income on your tax return. Please check with your accountant. I am just not as familiar with the forms there. I'm not sure if Corey can answer that, but I would say check with your accountant so that when you're looking at that, you're aware of what your modified adjusted gross income is in that case. A question on the example, so Jane's example. So I'm going to back up and we'll go to that slide very quickly. Where are the taxable events? And so the answer to that is it depends. I know that's not super helpful, but remember again that the employer contribution could be made as Roth now if your plan allows. So that might just not be something you consider a deduction when you're kind of doing the taxes for the business. The employee contribution could be Roth, or it can be converted later, just like employer contribution. So these two contributions may or may not have a taxable event. They might go right into the Roth bucket of the 401k when they are made. And then the third contribution, the employee after-tax non-Roth contribution, remember again, no deduction for this contribution, but you do have to do the conversion if you want it to grow tax-free. So here, at least, there would be a 1099 filed. What taxes you will pay is not a question I can answer. I understand it is non-deductible, but a great question for your accountant. So these two could, the first two contributions could potentially be a taxable event when you do the conversion. And then the third one, again, you may or may not have a tax liability since it's a non-deductible contribution. So I hope that was helpful. I know it wasn't exactly an answer, but I hope that that was kind of filling in what you were asking for. I think that, hold on, I think we might have maybe one more question.
The only one I see that we haven't addressed yet is, what if a trust fund is the beneficiary of an IRA? Can those funds be invested in rental properties? If the trust fund is a beneficiary, then the IRA itself has no limitation based on what the beneficiary listing is as to how the IRA account invests. So in theory, yes, that really, I don't think makes a direct or lineal change on anything. I'm not sure if maybe that was intended to be worded. What if the retirement account invests into like a real estate trust? Would you interpret that any differently, Larissa?
No, I think you got it, Corey. I think they're asking about the trust being the beneficiary. And in that case, so you're aware, when you name a trust as a beneficiary, then ultimately, once the account is inherited, the trustee will make decisions on behalf of that account. So just as you would expect. And so certainly you can name a trust, But also to Corey's point, you can also use a trust when you're making investments, land trusts, personal property trusts, lending trusts. These are all structures you can use when investing through an IRA. And so with that, I don't see any other questions. Corey, thank you so much for joining me today for this webinar. I think it went well, and I appreciate all the questions that came in during the course of the webinar.
Awesome. Thank you, everybody, for participating. Check us out on our next webinars. Go to the Advanta events page to see what other topics we've got coming up. Even if you can't attend it live, register for it. You'll get the email of the recording sent to you, or you could check them out on YouTube. Thank you so much, Larissa. I hope everyone has a wonderful rest of your day.
Bye-bye.